Hi everyone, remember the macroeconomic objective for growth is for strong, sustained and sustainable growth. And therefore, if the economy is in need of a boost to economic growth, what policies should be used? Well, that very much depends on the type of growth the economy needs. Remember, there are two types of growth. We have short-run growth or actual growth, which is a boost of aggregate demand. And we also have long-run growth or potential growth, which is a boost of long-run aggregate supply, increasing the productive capacity of the economy. So if the economy has got very low aggregate demand, maybe the economy is in a recession with a very large negative output gap with a lot of spare capacity in the economy, then we need to increase short-run growth via a boost of aggregate demand. What policies can do that? Well, our expansionary demand-side policies could do that. Expansionary fiscal policy or expansionary monetary policy, where expansionary fiscal policy would include increases in government spending or reductions in taxation, like income tax, like corporation tax. Or we could use expansionary monetary policy via a cut in interest rates or maybe a boost in the money supply through quantitative easing. And if these policies are successful, we can see on a diagram that aggregate demand would shift to the right, and as that happens, there's your increase in short-run growth from Y1 to Y2. By using up more spare capacity, the economy is moving towards full employment. Great stuff. But as we've learned in previous videos, very easy to evaluate these policies. I've picked some of the most significant evaluation points here. First thing is weighing up the conflict of objectives that we might get. And this diagram makes it very clear that, yeah, we might get higher economic growth. Yes, that also might bring down unemployment, but there is a risk of demand pull inflation and therefore inflation overshooting our inflation target, which is not desirable and not what we're going for. Remember that in macroeconomics, we try and achieve all the macro objectives at the same time. So this is certainly not what we're going for. And what you could do is weigh it up further by questioning the size of the output gap and saying that if the size of the output gap is relatively small, like I've drawn on my diagram, the risk of this inflation is more significant. Whereas if the negative output gap is very, very large, lots of spare capacity, then there isn't much of a risk of this trade-off, demand pull inflation. But we don't want that trade-off, certainly. But also there is another risk of widening a current account deficit, a trade deficit. And that's because as incomes rise with economic growth, there could be more sucking in of imports, more spending on imports by households, which could widen our trade deficit. We know that expansionary fiscal policies have the potential of worsening government finances, increasing budget deficits, increasing national debts, which cause issues in the long run when it comes to funding these policies. We've considered that before, and that could be very significant. We also know that a lot of these policies are dependent on strong consumer and business confidence. Our tax cuts, for example, our interest rate cuts as well. And we know that confidence isn't always high, especially in a recession when aggregate demand is very low. Confidence is very low, which could limit the effectiveness of these policies working in boosting AD and boosting short-run growth. These policies can also come with severe time lags, which could limit the effectiveness of these policies straight away in boosting growth. But what if the economy isn't operating with a lot of spare capacity? So let's go away now and talk about if the economy is at full employment or very close to full employment. What we don't need expansionary demand-side policies then. We need policies to boost long-run growth, policies to boost potential growth, policies to shift long-run aggregate supply to the right. We need supply-side policies in that case. And we've learned that supply-side policies could be interventionist or market-based. Either we can talk about and chain them up to a shift of LRS. So interventionist policies would include government spending on education, on healthcare, on infrastructure, but also subsidies to firms to promote investment. We can talk about market-based supply-side policies, maybe tax reforms like lowering income tax or lowering corporation tax, maybe labour market reforms, reducing benefits, reducing minimum wages, reducing the strength of unions, or competition policies like privatisation or deregulation. We've learnt then we can chain them up to LRS, and if successful, there is our shift and there is our boost of potential growth, of long-run growth from YFE1 to YFE2. The full employment level of output now is higher than it was before. Great stuff. That's what the economy needs if we're at or very close to full employment to keep growth up. But we can evaluate these policies in our usual way. We know that these policies are not guaranteed to work. The theoretical effects may not occur in reality. Different effects may happen in reality, which prevents the shift of LRS. We know that especially the interventionist supply-side policies are very costly. That creates long-run issues with funding, issues that could well actually damage the productive potential of the economy. We know that a lot of these policies come with significant time lags, so we're not going to see an immediate impact on the productive potential of the economy. And we know that market-based supply-side policies in particular have got quite negative stakeholder impacts. Our labour market reforms can impact on workers and worker welfare, worker living standards, but also our deregulations can hit the environment very hard, can harm worker safety, and also can harm product safety if that's deregulated. But when it comes to this overall topic area, guys, policies to increase economic growth, always remember is general evaluation, that the policies we need clearly depend on the type of growth, as we've made very, very clear. But also remember what the objective for growth is. We want growth to be strong and sustained. That means continuous. So high rates, continuously high rates. We want that, and these policies can help us get that. But we also want sustainable growth, remember that, and that is growth without significant inflationary pressure, growth without significant damage to the environment. Bear that in mind as well, important to consider when weighing up the conflict of objectives we've talked about before. That covers this topic, guys. Thank you so much for watching. I'll see you all in the next video.